Okay, all. So, thank you all for coming, and thank you for Merritt. We've just seen his very neat handwriting, so it looks like you're in for a treat. Real calligraphy show today. Um, right, for those of you that know Jigsaw, have known us for a while, you know that we think you should be exposed to as many views on trading as possible. But of course, that's as long as those views aren't about trading horoscopes or moon phases or something crazy like that. So we're very selective about who we bring along to chat with the Jigsaw community. So I'm very happy that today we have Merritt Black along today. So Merritt is the head of trading for SMB Futures, which is a fairly new offshoot of SMB Capital. I'll leave Merritt to fill you in on that and who he is. So thanks for coming, sit back and enjoy, and thank you, Merritt. And you can take it away.
Fantastic. Well, first and foremost, just I appreciate you having me. I've always held you, Peter Davies, and Jigsaw in the highest regard, and I look forward to plenty of ways that you and I can do things together to add value to people and share our views and collaborate and do all kinds of stuff. So hopefully this is just the beginning here. So thanks for having us. So guys, today, I do a lot of presentations where I don't have a PowerPoint. I do a lot of presentations where we pull up a chart and we just go. And today's going to be a little bit different because I really want to express some overarching truths, and I hope to really open some eyes today is really the best way to put it. I think there are a lot of different ways to go about trading, but I think there are certain fundamental truths, especially in the arena that I'm guessing a lot of this audience operates in. And so let's start to dive in. We're not a broker dealer, educational purposes only, you know the drill. So who's S&B Futures? We're a prop desk, as Peter mentioned. We are right here in Midtown Manhattan. I could open my blinds and you can see the Chrysler building out the window there, but the sun's a little bright, so we'll keep the picture quality better. S&B has historically been an equities desk. You probably know who Mike Bellafiore is. You've probably read one of his books, One Good Trade or The Playbook. Our firm has our own kind of windy roads, if you will. Dr. Steenbarger, I'm just so blessed to be able to work with him, and he just helps me out tremendously. And I say all this to show you that we're kind of the real deal, right? I know that you guys may attend a lot of different webinars. I'm sure the ones that Jigsaw hosts are of the highest quality, but there's a lot of bad out there. There's a lot of just kind of self-proclaimed gurus, and I kind of want you guys to know that we're something a bit different. Recently, we launched this unusual community. We're in the process of rolling out some unique kind of programs and different things. I'll kind of tell you a little bit about that at the end. We're really just bringing to light a lot of our tribal knowledge, if you will, and sharing it with you guys, because we have a real motivation to do so as we are looking to build out a new division, a futures arm to our prop desk. Okay, you should know that there's, like, I can see guys in this picture that make 7 figures, mid 7 figures each and every year solely from trading. So this is who we are. Who am I? I'm a pro trader. I have over a decade of experience. I head up S&B Futures. I trade for a living. I think that's very important as someone you might consider listening to. I really am passionate about this stuff. Today, I think I'm going to be dispelling some myths, some misconceptions, and really, really passionate about developing CPTs, consistently profitable traders. It's my mission. We really did think long and hard about how to add value to you today in a unique way. I know there's plenty of people probably on this webinar right now that are in our room and have heard me talk ad nauseum. But today we're pretty excited about what we're going to talk about. We're not going to show you where to get in and where to get out. Like I said, we're usually pulling up charts and doing a lot of that. Today's going to be a little more philosophical, if you will, but extremely important. Again, there's no secret systems. That's if that was possible, every one of us on this call, we wouldn't even be on this call because we'd all just be multimillionaires and easy how to get in and get out. It's not that easy. As prop traders, someone recently opened my eyes to this. I'd never thought about it before. We're the closest thing to retail trading that exists. I was on a bachelor party in the Dominican Republic last year, and there was a trader from Goldman there. And we clear through Goldman. We do business with them. But a trader from Goldman, okay? You guys sitting at home couldn't be further from the trader at Goldman. It's entirely different worlds. They have privileged access to things, information flow that we don't have, all kinds of things. But as a prop trader that sits in my seat and all the guys on the desk around me, we're essentially professional retail traders. We really are. Sure, we get good commissions and things like that because we do volume and whatnot. But I mean, we really are really close to what you guys do. So take heart in that. The only real difference, other than maybe some, lower commissions, is how we think. Pros think differently. Okay. If you've never read Mark Douglas, Trading in the Zone, he talks about the best traders he's found. They think about markets differently. They think about trading differently. We see markets differently, manage risk differently. So bear with us as we start here. We're going to show you the real reasons trading is hard, why simplistic solutions is never going to get you there. We're going to show you the beginnings of a solid framework. If you can internalize this through a ton of practice, a ton of effort, we can make you think and act like a pro. And this isn't just fluff here, guys. We really, really mean this stuff. And we train traders to do this kind of stuff. We hope this will end your search for the Holy Grail. You start asking the right questions and looking in the right places. All right. Financial markets did not exist through human evolution, if you will. Okay. A lot of stuff out there is super stimuli. Humans are not evolved to handle that, much like a fast food burger or the social media app, right? Marketers, products with this super stimuli, all the bells and whistles, all these kind of things, McDonald's, Instagram, they can exploit our naturally bad responses to super stimuli. This is something that traders have to address. The very real problem. Information overload, access to reliable training and peer review, trading without an understanding of how markets really, really work. These are all dramatically compounded. These natural problems are dramatically compounded by the presence of these super stimuli. So, cognitive biases, okay? In the presence of information overload, this reward punishment circuitry hijackers such as super stimuli, our brains act in predictable ways, guys. This has been well studied. It's a real problem. All cognitive biases exist for good reason. Seek pleasure, avoid pain. I think in trading, a lot of times we're really looking to avoid discomfort. It's a really, really big deal. If problems are solutions that have outlived their usefulness, something Dr. Steenbarger talks about, it's a direct quote. Cognitive biases are either A, solutions that have outlived their usefulness millennia ago, or B, shorthand solution attempts that help us poorly, by the way, cope with what we were never equipped to handle in the first place. In order to trade successfully, we need to master 3 areas, guys. We're getting into this framework now. psychology, methodology, and risk. Okay. None of these three things are optional. Methodology involves the way we see and analyze the markets, our specific edge. We know that an edge is nothing but a higher probability of one thing happening over another. Without proper risk management, most edges cannot be consistently realized with any style in any asset class in any time frame. We can't bypass information overload, these super stimuli, aka the psychology aspect here, mental game products, holy grail seeking, mechanical trading even. I've met many a mechanical trader who deals with emotion just as much as a discretionary trader, despite that being the reason why they got into that field. You can't successfully execute an edge consistently before you understand and internalize how the market really works. How the market really works. And there's multiple levels of how that works, and we're going to talk about that. This is why most retail traders lose money even when they've been given a winning system. You've all probably heard the phrase, you show 8 people a system and or an edge, and you end up with 12 different systems that come out of that. So are you depressed yet? Are you all liquidating your trading accounts? Help us, Obi-Wan, right? Is there a way of seeing and analyzing the markets? Can it be a way out? Is it possible for the right answer is not a system or strategy, but rather a framework, keyword, for bypassing these cognitive biases, aka fixing our psychology, objectively vetting our presumed edges, methodology, and identifying asymmetric risk reward and managing that opportunity, if you will, properly, which is where the risk comes into play. In order to arrive at this framework, let's first examine what it is that we don't trade. And hang with me, guys. This process is what we call via negativa. We're going to arrive at a truth by a process of elimination. We do not trade what must be. This opens the door to the cognitive biases. The market must do nothing and may do anything. The 87 crash was an 18 sigma move. The math doesn't make sense, guys. If you take a look at all the past prices up till that point in time, it could not have occurred, must not have occurred. Not only do we not trade what must be, we don't even trade what should be. It opens the door to cognitive bias, sabotage of the trading. I love this. Thou shalt not should on yourself. Okay? The desperate motivations of participant groups who act independent of and unbeknownst to each other, which is true, guys, cannot be reduced to some value judgment. We all know the famous phrase, the market can remain irrational longer than you can remain solvent. You're not gonna win as a trader by trading and what should be. This should be. This must be. This should be. We don't even trade what may be. This still opens the door to problems. May, okay, we're getting better. Okay, may implies probabilities. In its best case scenario meaning, it connotates a greater odds of one thing happening over another. And that's good. We're moving in the right direction here. But may is still not actionable in the absence of what we're going to talk about is just enough confirmation from real-time market-generated information where the edge is more likely to play out as expected in this particular instance. Are you ready for it? Here it is. We trade what is. I know my guys in the room have heard me say this. I trade what is. What is simply what's left when you eliminate what must or should or may be. We trade what is. What is trains us to see things as they are, not as we would like them to be. You know, if we were all in a room together here, I'd say raise your hand if you've ever fought a trend day because of what you thought maybe should have been, and you look up at the end of the day and you feel like an idiot. How could I be so stupid? It was staring me right in the face, but you couldn't see the truth. You couldn't see what was. You weren't trading what is. This prevents us from being unwitting gamblers. This transforms us into real traders for the first time. What is gets us out of the prediction business, even the anticipation business. I have an error that I mark when I take a trade. I will tag a trade as being anticipatory. That's a mistake for me when I do that. So we want to move from the prediction business to the anticipation business, which is what everyone thinks trading is when they first start out, into the pro trading business. And that's different, and that involves being at the hard right edge and truly understanding what is, being able to speak a language of the markets, okay? We have to know how markets work. We have to learn to speak that language. Vendors will sell you everything under the sun, guys. Tools, platforms, indicators, you name it, except the one thing that's most needed. That one thing makes all the products and services putting the cart before the horse. That one thing is an understanding. And again, you're not going to necessarily walk away from my talk here today once we cover some amazing, magical things here over this next 45 minutes. But through internalization of what we talk about here and deep practice, you're going to be able to develop this understanding and see how markets really work. Again, cart before the horse. This understanding must precede the acquisition and consistent, successful execution of even an edge, a setup, if you will. The solution, therefore, is a framework that instills this market understanding by training you to trade what is. Are you with me? Are you fired up? So here we are to the topic of today's talk, context and order flow, twin truths of what is. There's two essential components to the trading what is framework, context and order flow. That's why we call this talk context plus order flow equals success in trading. Both are necessary but not sufficient conditions to developing deep understanding of how markets really work. Both are necessary but not sufficient conditions to consistently trading what is and asserting that proven edge. This framework can be expanded for better accuracy, but the simplified, hear this, guys. So all the guys I mentor and work with all the time, they hear, oh, Merritt uses this. I heard Merritt uses this. And I'm working with them, building them from the ground up, specific skill development on top of core skill development, on top of intermediate skill development, on top of, we're building these traders, and they hear something that's up at the top of the iceberg, and they go put that on their charts and start learning it and trying to apply it. And they have all these holes in their development. Okay. So hear me out. The simplified version works best for most developing traders. I guarantee you 8 out of 10 people on this talk today are in that category, developing traders. Price action. Okay. Trust me, guys. I used to be a pure price action trader. I didn't use context. I didn't use order flow. I was right there in the price action field. I was clean, naked charts. I didn't believe in indicators. Pure price action, price tells all, blah, blah, blah. price action is good. Price action is good. And it remains part of this contextual analysis that we're going to build out. Trading pure price action is certainly better than, screens with 15 standard setting indicators, or even worse, some red or green arrow that just tells you to buy or sell, right? But price action on its own is not enough. Any of you who have ever studied market profile, auction market theory, read Jim Dalton's books, we understand. We firmly believe that price is nothing more than an advertisement. And more often than not, there is no truth in advertisement. Price is this is an auction process, guys. Price is advertising. Are buyers interested here? Are sellers interested here? Hey, can I have 50, 50, 50, 51, 51? Hey, 55, can I hear 56, 56? It's an advertisement. So stop looking at price alone. Look through price at value. Value is a composite quality, guys. It's comprised of 3 different data streams: price, time, and volume. This is deep stuff. This is very meaningful, deep implication stuff that we're talking about here today. Context redeems price action by putting it into context. Okay. Where do we have evidence of value or balance? These are very similar and closely related terms. Where do we have stopping power or volume over time? Context tells us a narrative, if you will, guys. It tells us where we are in a story that's unfolding. Thus, what is more versus less likely to happen? Next, where do we likely have trapped traders? Thinking about that, understanding the way markets work, being able to see this truth of the way things are with markets, allows you to really start to understand where other participants are trapped. And I know Peter does a great job on, as far as I know, at least the smallest time frames, the order flow type thing, of understanding that very dynamic there. You've got to be able to understand who's trapped and where. It's very powerful, because we know that in order for a trade to work, you've got to have a bunch of people, if you get long, to buy after you buy. That's the only way it works, right? Whether they're stopping out of stuck shorts or initiating new longs, doesn't really matter. That energy is required for us to be profitable. And energy is a big word you'll hear me talk about a lot. Context gives us evidence-based support and resistance. And this second part is key. It also helps us discard all other levels. Do you know how many levels, if we were just to poll the room and say, okay, S&P 500, what are the levels? We might not be able to see the chart anymore if everyone could draw their level. Okay. All levels are not created equal, guys. Also, complexity, as we talked about with all kinds of things earlier, complexity is a real problem for traders. All the bells and whistles, all the time frames, all the things that we could possibly do. Boy, as a human, it can become too much. I always tell people, first do the simple, then be better at doing the simple, and then simply be the best at doing the simple. There's elegance in simplicity. There's robustness in simplicity. There's repeatable process in simplicity. So the skills and the tools when it comes down to this, some things that we view and use. Skills, we need to understand price action. We need to understand auction market theory. And we need to understand market dynamics, how markets move, various ways in which they consistently behave. What are the tools involved in deciphering context? You can use price charts. You can use some indicators. Market profile or volume profile, I find massively key. I will never forget when my eyes were opened from going from price action charts with volume on that x-axis at the bottom, being able to see where there's a high volume coming in or where there's low volume bar to bar, versus seeing where volume is trading on the y-axis. I'm speechless even now when thinking about that moment and the realizations that were garnered there. So massively important tools is tracking the distribution of where price is being traded most and least and things like that. So, here's one example of a market dynamic of roughly a dozen market dynamics that we teach people to see using market profile. So here's one. If price accepts into a balance area, it is likely to revert to the other side of that balance. So the third bullet here, for those of you that don't quite follow that, when an established and still valid range, okay, is re-entered, we previously leave it, we come back to it, and that support resistance edge, the edge of that balance or range, holds from within, price is likely to test the opposite end of that range. Okay, so this is a very simplified version of what this might look like. We have that established range, high and low and high and low, and then it breaks that range down, but that breakdown fails. Okay, and you can see a very aggressive entry here, a couple conservative entries here, and our target would be up towards B. Market profile graphic. I'm not going to be teaching market profile today. I'm taking it that most of you understand what we're looking at here, because I know that Peter also uses market profile and whatnot. So here is some recent action. One thing you'll find about me is that I am not a fan, and my BS alarm goes way off when I see just these presentations with all of these just cherry-picked examples. Any of you guys that know me know that when I come to a presentation, sure, there's a time and a place for some very good cherry-picked examples, but I greatly prefer to say, let's look at what's recently happened. So this is crude oil, just before the market broke down, where we had this dynamic that was possibly occurring. It hasn't been occurring since then. So you guys recognize the blue dots in the A period. That's where the market opens, okay? So we're going to look for days. Each one of these blobs represents one day. We're going to look for days in which the market opened outside of the prior day's value area. The value area is the gray upper and lower boundaries. Point of control is the red line. The blue A is where we open. So right here where my mouse is, I believe you guys can see my mouse. I'm not positive. Can I get a confirmation real quick from anyone? Can you see my mouse? Great. So this day would be an example where we open below the prior day's value, outside of that balance area, that established range-bound period of market activity. So let's highlight every instance in which that occurred. There we go. 1, 2, 3, 4, 5, 6 times. This one was right at it. It would have been another great cherry-picked example, but it's right at it, so it wasn't outside it, so I didn't include it. Okay. So we have 6 times in which that occurred. Look at this dynamic playing out. We open outside. When we're able to get back in, we traverse to the other side of that balance. We open outside. When we're able to get back in, we traverse to the other side of that bounce, which happened to create the high of day. We open outside. When we're able to get back inside the bounce, we traverse to the other side. We open way outside the bounce. We get back in. Also another high of day. That's kind of the destination for that. Another one, we open outside of bounce. We're able to get back in. We push through low of day into the other side of the balance. This day being the one time where a different dynamic occurred, we push into the balance and the value, but that point of control checks us up hard and rejects us. I believe this was an inventories day, so that was that deep period spike into there. So one example there where it didn't work perfectly. Okay, but this stuff is extremely powerful, and it's not that you want to hear me just say just that one simple thing. Although that's great, you can take this that I'm just telling you about, one simple market dynamic, something that we know to be true, that puts us in a positive kind of expectancy and able to see the risk reward at that moment, trading what is. Okay. Notice none of these times we tried to predict that, oh, we opened outside of balance, I bet we're going to go traverse it. No, we wait until it is inside. Okay. Powerful, powerful stuff. Here's a price action example. Trust me, I know price action, guys. So let's analyze this from a price action point of view right here. This is the overnight high. We have this established range. We have a nice little trend line right here in yellow. We failed to break out of the overnight high shortly after the market opened. The open is here. We break down this nice little uptrend, beautiful little trend line that touches 1, 2, 3, 4, 5, and then it breaks on the 6th time. Nice little weak looking kind of pullback here. That starts to break down. Just about any pure price action person is going to analyze this sequence roughly the same way. We have a failed breakout of the upper end of the range. We have a trend line break. We're starting to make some lower highs and lower lows. There's no other way to analyze that from my understanding of like a classic charting, technical analysis, price action point of view. But remember, that's just price action. That's all it is, right? Just price action. We said price action alone is not enough. Here's the exact same chart. Let me flip black so you can see. That yellow line was here. Okay. This line that I have drawn on the chart, let me go back several slides. This is an intraday chart of this right here, this day. That's what it is. And the dotted white line that I drew is this value low that we would be really looking for as a key level to see if this particular market dynamic is playing out. Let's go back to it. And there it is. We push back in, we retest it from inside, and we go. This is not a cherry-picked example. I literally scrolled to the first one and said, yep, that'll be a good example. Let's put it in the presentation. Context provides us with solid evidence-based levels derived from what is. This is not arbitrary math, okay? Indicators, fibs, pivots, all of these kind of things. Not that there's never any use for those things whatsoever, but this is different. This is context. All known levels by definition created by past activity. We can surmise, but we'll never know the positions, outlooks, and motivations of other participants. All support resistance is potential support resistance until proven otherwise. Without help from order flow, we can get whipsawed into oblivion. We can exit winners early. We can take larger losses than we should be doing. Context without real-time market-generated information equals overtrading, edge sabotage, poor risk management, you name it. So context is fantastic. Context is, it's one of the holy grails, if you will. It's part of this magical framework that I'm teaching that I use in my own trading. But context alone is not enough, guys. Order flow, the living, breathing market, Order flow provides us with a moment-by-moment, real-time market-generated information. As such, it's the highest level magnification tool in our toolkit. Really, really zooming in. It tells us what just happened. It tells us whether or not the trade is on, the setup can be trusted. There's a form of confirmation of something's happening right now with this knowledge of a contextual situation that we're in. Order flow can keep us on the right side of a trade. It can confirm or deny a thesis, movement. So the skills and the tools of order flow. And I know you guys probably you guys could teach me about some things with order flow as well. I'm sure plenty of you in this room right now, based on having studied from Peter and whatnot, are order flow masters. So this is just a broad stroke thing here. Skills: recognizing what side of the tape is being more aggressive now. Seeing absorption where it occurs. If you don't know what absorption is, you better start to learn what absorption is. Recognizing the speed or tempo of the tape, of the order flow. Plenty of tools to do this kind of stuff, right? Basic stuff, level 2, time and sales, DOME, cumulative delta gives us a kind of a volume x-ray. And then you got your specialized tools like Jigsaw Day Trader. Cumulative delta. This plots the accumulation over time of volume at the ask minus volume at the bid. And you simply reset that whenever you want to for each session, for example. It shows order flow over time. It's funny here on the equities desk. And there's some complications with it based on the large spreads that some of the things these guys are trading. But most of the equities guys, they're old fashioned around here, and they stare at a time and sales and they kind of surmise, okay, there was 4,000 on the bid here, but I see now that we've traded 40,000 on the bid. And they're literally calculating it as it scrolls through. All of you guys know, as futures traders, we have some pretty cool tools to help us see those kind of things. This is true. A lot of people think that institutions do nothing but use limit orders. That's not true. I was having a beer with a large institutional futures trader just last week, and they certainly use algos to kind of drip and aggressively get into positions. Therefore, using something like cumulative delta can really, really show you what's happening with some large players' presence and intentions. That's the cool thing about the big boys, is they pretty much can't hide from us. They can't hide. Common uses: we can confirm or deny price movement through things like simple divergences, positive or negative divergences, reversals. One of these key skills we listed was monitoring for aggression. Okay, we talk about cumulative delta. Part of that skill involves recognizing not only aggression, but when aggression is lacking. So again, we're not going to go cherry pick some example from 2001. Let's take a look at yesterday.
So I just created this dope website with Wix.
Before we got into the open, okay, and the open is right here, where the edge of this profile is, 9 a.m.
Yes.
for crude oil. Before we even got to the open, back at before 7 a.m. over here, we can see that price started to make this lower low. And again, if we're only studying price, that's the end of the story. Prices continue to make lower lows. Well, guess what, guys? There was a shift in the dynamic of who's being aggressive and where, as the cumulative delta shows. So this was actually a higher low while price was making a lower low. That's a form of a positive divergence. And we're seeing a bit of trouble from the sellers. They're not actually getting done what price the advertising mechanism might have us believe. Right off the open, price, and I traded this. This was a pretty fast move. I imagine this would scare a lot of people. It just, boom, the open comes, selling off, right? But when we take a look at that underlying aggression, or even better in this case, lack thereof, it's not quite so scary. It's not quite so scary. You see that there's not really that much behind the move, and that it's just advertising lower. So as soon as those buyers come in, that just so happened to be a trade that we've been looking for. In fact, one thing I wanted to do, let's see here. We have our futures Slack room here, and I have this search that I can run, post from me in our crude oil trading room. Okay, let's just scroll back. Okay, so on the 18th, today's the 20th, right? Okay, so 2 days ago, 9:45 in the morning, big picture, I see potential for a move up to $69. We were trading quite a bit lower than 69. That was a bold type of call, multiple dollars away from where we were. Right before the inventory number comes out on that day, one hypo is for me to have this happen. We restabilize above these levels, blah, blah, blah. 9:30 a.m. yesterday. For what it's worth, that likely to go to 69 call I made yesterday, I'm now adjusting that to 68.70s. And then once we reach 68.70s, after that destination is reached, guys, the risk reward is more favorable to shorts unless this market really starts to hold above 68.70s. Okay. Little market profile chart here. On the 18th early morning, you know, we're trading way down here in the 66s. Over the next 2 days, we do get that move up. I adjusted the target from 69 down to 68.70s. And once we got there on this day, once we reached 68.70s, I posted probably better risk reward short. And so today, as we came in, we really liked being able to fade this upper area for a move to, guess what, guys? Traverse this balance area. Very simple stuff. You already see like the things that we've been talking about here today. You know, I'm walking the walk. I'm talking the talk. I'm making these comments in the room and sharing what I know. And this is real stuff. This is real stuff that I use on a day-to-day basis. And I just wanted to show you guys some of that, not to pat myself on the back, not so you guys think that I'm the hottest thing since sliced bread, but to simply share with you that this stuff works and that I really, really use this stuff. It's very important. Is order flow only for scalpers? I hear this all the time. Intraday traders and scalpers are the most common users of order flow tools, but precision entries and exits would improve the expectancy of any trader. I mean, believe me, again, back to that beer I was having with that big fund guy. We were having conversations and sharing ideas around the way he comes up with his views, the way I do what I do. And we were talking about how much value some overlap would be. And we're going to open up a line of communication and help each other in some ways. And he's extremely interested about reading order flow, even though he's trying to catch a position over the next 3 months. It really does matter. All traders are intraday traders on the day they enter and exit trades. It's very much possible to make a living order flow scalping. The big money's in the big swings. We don't want to train our minds to step over dollars to pick up pennies. The most profitable use of order flow may therefore arguably be enabling us to stay with the big moves, to precisely time getting in to the big moves. Peter might disagree on this fact, and that's fine. I look forward to many a conversation with Peter where we can discuss our views openly and whatnot. And we're all here to learn from each other. So there's different ways to think about things, but book after book after book through history talks about being able to hold positions. That's the tough part of being a CPT, being able to catch the real moves. So it's a belief we hold very dear. So order flow is also necessary, but not entirely sufficient. It enables us to hold the pulse of price. It keeps price movement honest. Order flow allows us to stay with winners, exit with small losses, often before stops are triggered. I know that's one of the compliments I've gotten recently is Merritt has an uncanny ability to see stop runs and different things before they occur. And that's all order flow. I don't have some unique magic ability as a person or superior type of skills. It really is process driven, learning the language of the markets, learning how to do these things and building skills. But without context, guys, order flow too still gets us whipsawed into oblivion. Trust me. For us to have a profitable trade, others must enter and or exit in our direction after we get in and keep doing so. Sustained moves that reach reasonable targets are much more likely to happen near the edges of structures at great levels and under conditions determined by a context. This is something that I would argue with Peter if he disagrees till probably the day I die. All the order flow support in the world in the middle of nowhere and or without the proper context is highly unlikely to lead to consistent profits. You're using that tiniest magnification to see the little bit of what's going on just second to second. And I would argue that one can lose the forest for the trees. There's a reason that is a phrase. It's very, very important to have some framing of context to be able to apply order flow within. The framework introduced here is one of the very few concepts in trading that are truly equally applicable across all asset classes and timeframes. What about people who aren't discretionary short-term futures traders like me? Often market profile, auction market theory, order flow toolkits are seen to be this realm of just the discretionary guys. Let's look at some examples here of non-fully discretionary trading styles. Are you indicator-based? Can you use this? Absolutely. Improve those indicators and the signals they get by avoiding some. Imagine if you could just avoid some false positives, false signals, knowing when to trust a trend, the momentum, and when not to. Neutralize the indicator lag. Massive ways that you can improve someone in that space. Very rule-based traders, absolutely. Improve by improving or approving, if you will, execution on a case-by-case basis based on levels, context, order flow. Not changing the rules. You're simply, again, avoiding some false positives. This is massive bottom line improvement to trading. Even fully automated people. Calculation of recent levels based on market profile, quality, balance, these things. When to stay out when context is giving a market dynamic that you've come to understand and know and study that negates a setup. You can add filters, quantify these things, and really, really improve systems. This is all good stuff. So we put it all together. We determine balance and levels objectively. Part of that thing we talked about many, many slides ago was that simplification, that elegance, that robustness. Determine, balance, and levels objectively. Identify the current market condition. Identify the most likely scenarios or hypos, okay? We've got our context framed. We can move into the setup world now. Let the market move, let price advertise, let volume confirm, validate a hypo that we could see unfolding. Objectively determine.
I can learn to understand you much better if I can
place evidence-based stops and targets. Now, into the order flow. And where you use those stops and whatnot, that could actually be moved around in between any of the three, depending on your process and methodology. So I just wanted to clarify there. But now into the order flow. We verify expected participation in the now, trading what is. We can vet price movements while we're in the trade. Is this move healthy? Is this move unhealthy? Do we have market generated information that's causing a concern here? By the way, whenever you do feel a concern, a fear, something like that, self-awareness is massive, guys. You want to break apart and understand, is this thing I'm feeling derived from some emotion or biology of mine? Or is this market generated information telling me quality information? So verify, vet, stalk trade, continuation, invalidation, and overall inflection points. Order flow is massively, massively important for this. So to kind of help you remember this and put it all together, objective. What's our objective? Let's climb the equity curve mountain. Context. We've got a map of the territory, current weather, trail conditions. We know the context of what we're getting into. Hypos. We got a few identified trails that groups of hikers are most likely to end up taking today, determined by the map, the conditions, the context. All hypo trails can lead up the mountain through different paths. Setups. Trailheads to one or more identified currently usable trails, our hypos, appearing on the journey with clear trail maps up the mountain available at the trailhead. And then we've got order flow. Trail markers, the little things that they put on the tree along the path. Signs showing if any part of the trail is now safe to enter, unsafe to enter. Determine which trails, setups should be taken and for how far. It's a wonderful way to kind of help you remember how all this works together with kind of this analogy. So, a partial list of framework benefits. Filter out poor signals. Vastly improve results by avoiding a lot of those false positives. All ascending wedge patterns are not created equal, guys. You put an ascending wedge within a context, now you're starting to talk. Now we're starting to talk. Know how to expertly manage trades for the given situation. This is massive. How many times do I see people continue to stare at the dome perhaps, or continue to trail a stop behind, let's say, 1 minute bars when you're trading perhaps a market profile, prior day balance area type of trade? You've got to understand the context and know how to expertly manage that particular contextual situation. There is no one size fits all trade management scheme that you should just blanket apply to everything. You need to understand there's better ways to manage certain trades in certain environments and other trades in other environments. People, you probably don't believe me when I say this, but people that are in the Slack room, they are believers. Don't get caught off guard by big moves. Okay, that sounds like hogwash probably. And of course, there's, Trump tweets something and there's a move. We were not ready for that, of course. But a lot of big moves, I'm talking, for example, the example I gave you earlier where I'm talking about guys who are really seeing a potential for a move up to 69. All of a sudden, the market trades up several dollars, higher than, above average range. That wasn't surprising. We're not caught off guard there. We're not fighting that trend. The big $5 sell-off the other day, it went a little further than we expected, but I had a meeting with a guy early that day before the sell-off was underway, and we said crude could very easily pull back into 72, and we were trading way higher than that. That was on the previous month's contract levels. So you can see this stuff, guys. You can see the big moves that happen. See your existing setups and strategies with clarity for the first time. I really mean that. Avoid emotional trades and overtrading. Stack odds dramatically in your favor with that evidence-based risk reward. The key word there, we all use risk reward, but evidence-based. A lot of people create risk reward out of thin air. I'm in a trade, I go for 2-to-1, baby. That's what I do. So I'm going for 2-to-1 on this trade with no regard for what the market is telling you is truly possible at that point in time. Find precise, low-risk trades. Again, any time frame, any asset class, this framework works. Manage risk, job number one, like a pro via superior trade location and order flow support. Speak the language, guys. These concepts we're talking about are critical to the way pros think and trade. Without understanding, practicing, internalizing these concepts, you may never exit the mirror maze and will likely always remain looking for the next holy grail. Your boom and bust cycles of your P&L curve. Losing money despite knowing that you've got a winning system. And just general inaccurate narratives that you have. You don't understand the language and have this very inconsistent performance. I genuinely hope that some light bulbs have gone off today. I really do. So a little bit about us and some opportunities with S&P futures. Won't take long. Just a couple little things here that you can do to get more of what you've heard today. We have a market profile course, different than any market profile book or anything you've read. Trust me. We use market profile daily, just like you've seen from me. A lot of market profile is esoteric, let's call it, okay? This market profile course is very objective, practical, and actionable. It will teach you to speak the language of auction markets, okay? The course comes with an exclusive private Slack channel where if you want to know what are Merritt's levels derived from, or hey, Merritt, let's compare. Do I have it right today? And ask others in the room. People who are framing context and speaking the language can share those ideas together in a safe place. We're developing an even more comprehensive boot camp version with a ton of progressive skill development, drills, ongoing Q&A that comes with it. If you do get our market profile course, we will grandfather you into the new one. Probably going to save a lot of money by doing that, but that's really cool. Opportunities 2, the Slack room. We have a pro-led community dedicated to futures trading with several high-quality professional traders, experienced traders in a no BS environment, guys. If you want to come into our room and you want to get kicked out of our room, just make a trade call in hindsight. Just say, yeah, I shorted the top and I'm covering now for 8 handles in the S&P. You're gone. You're out. All you're doing there is fluffing your own ego. You're not adding value to the room. And everything that we do in the room should be to add value to others. Here's where I'm seeing risk reward, guys. Here's a key level I'm seeing. Here's my hypos for the day. Here's my pre-market prep. Here's a review of a trade that I did. Here's a review of my day. I trade live there most every morning. I actually took the past couple days off, but most every morning I'm in there trading live. You see my screen. You see my order fills. When I enter and exit and scale out and scale in, do anything, you actually see my fills on the chart. Not a recording, not a cherry-picked example of when I traded well. You get to see me have losing days. It's a big part of who I am to, again, in this industry, show that I don't just talk the talk, I walk the walk. I also want to inspire people and show them that it can be done. Trust me, guys, I have cried over trading more times than I'd like to admit. Cried. It is so, so tough. But this framework and a lot of these things that I'm talking to you guys about today really will shorten your learning curve and truly, truly help you come up the curve faster and better and smarter. Slack charges us $7 per user in our Slack room. We charge you $7 to be in the Slack room. We don't make any money off this. As you can see, my marketing guys are planning to increase the price of the Slack room. So if you're in our room now, again, you're grandfathered in. We're not going to raise any prices on you. Here's a big opportunity. Become a pro. Why am I even talking to you today? What are my motivations? What's Merritt trying to sell us? Is it his market profile course? Is that why he's here? He's on his promotional book tour? Nope. Nope, nope, nope. I'm talking to you today. I'm taking time away from my trading. I'm taking time away from my desk traders because I want to find talented traders. No matter if it's someone that's already a CPT and they've got the statements to prove it, or if it's someone that is just beginning to see that consistency and they could really use a lot more development. I want all those people. We're building a desk here around transparency, communication, openness, a culture of getting better every single day. This is what we're doing. And we're offering a way for anyone around the world. Our hiring process, our HR involves you showing us that you can put up risk-adjusted returns in a paper trading environment. That's it. Very, very simple. Transparent tryouts. We're a real physical Wall Street prop desk. You can, if you're hired by us, come sit on our desk. You can also trade remotely if that's where you like. Here's my email address right down at the bottom. Questions, comments, anything about what we've covered today, whether it be the framework and your trading or whether it be ways you can get involved with S&B. You can always go to our website, smbfutures.com. But now, if I know we're, I suppose, running out of time, I'm not sure exactly the expectation, but I am open to take questions, especially around the framework and getting better and doing those things. Right. I have it. Let's see. I'll pull up. Cool. I have another webinar later, but yeah, we'll spend all the time we can. Is anyone trading stock indices? Absolutely. We have traders that focus purely on trading the S&P, the Russell, the NASDAQ, the Dow. And we have, within our community, we have specific rooms dedicated to, this is the indices only room. So we don't have a lot of overlap. If someone doesn't care about crude oil, they don't have to listen to me ramble about crude oil. How long is the tryout? It's as long as you need, but it's a minimum of 15 sessions. How did you manage that crude trade? I got out when we ran up into the next main significant market profile structural balance area. I exited into that target area. What MP software do I use? I use Sierra Chart. What do you look for to confirm a successful test of a previous range? And let's be clear on range. We're not talking about prior day's high or low. We're talking about a balance area, value, very important there. A couple key things. One, you want to look for not just what might be a head fake through the level. Let's say that we're breaking out of a range to the upside. You don't want to just look at, we've gone one tick above the upper end. We've gone 2 ticks above the upper end. You want to look for significance of the price action, of the volume, of the move beyond the range. And then when you want to look for, what I look for, there's different ways to do this, but what I look for, I'm always looking for weakness. Just like that long that I showed you that I got in from kind of that low of day of crude and caught the good move. I identified, as we could see with the delta and whatnot, a lack of real quality selling. So I look to fade weakness. That's a big phrase that I use. I understand context, and now I use order flow and price action to identify strength and weakness, and I look to fade weakness and go with strength. So I hope that answers your question. Obviously, we don't have enough time to. Okay, cool. You like the answer. Good. How do you take the MP course? Just go to our website, smbfutures.com, and you'll see all things that you can do to get involved with us. Trading. Absolutely, man. I trade 90% front month crude oil. I think it's the most beautiful market in the world. I love it. I think it has the perfect blend of momentum and speed. So absolutely, man, you're in good hands, and we won't hold it against you that you're Irish. Is you sure? What could you? Sorry, guys. The questions are just streaming through. I'm trying to stay still in the chat. What could stop you from taking it? Because the first instinct would be for imbalance conditions to remain. Yeah, so Jose, your question around, he's saying, all right, if we've got a confirmed breakout, what could stop me from taking that breakout trade or pullbacks resulting after the breakout in terms of order flow? First instinct is to say, well, this imbalance conditions remain. Your first instinct, by the way, this person mentors with me, so he's just using this time to get some extra mentoring. You already know your first instinct is right, JD. It's you want to trade what is, right? You don't want to get too anticipatory and look for little clues or scan 20 different charts and say, aha, there's something that confirms my suspicion, like one out of, and is that a real like massive variable for you taking that particular trade? Is it a playbook trade that you have identified? So stick with your key variables. As traders, we want to do 2 things every day. We want to execute the heck out of our process flawlessly. That's what we really want to do. And so what that means before I go to the but, what that means is we don't want to pull put some indicator on a chart or pull up some brand new time frame and say, okay, well, this doesn't look good, so I'm not taking the trade. That's not a part of your process. So don't introduce new variables like that, okay? But you do want to continually be a student of the markets, okay? We do a thing, and we actually have rooms in the Slack room for this. And all of our equities traders do this on the reg. It's called Book of Charts. That's what we call it. You build out your book of charts. If you note something interesting about a particular order flow instance, if you note something interesting about a certain bit of price action, if you note something interesting about some dissonance between time frames, if you note whatever it is you find interesting and something you perhaps want to study, jot it down in your journal. By the way, you all have journals that you keep and write in, right? Like this is you do that, right? You got to do that. Jot it down and then stay focused on your process. And then as a part of your review process, go back. Okay, 9:47 a.m. in crude oil at this blah, blah, blah. Okay, let's go take a look. All right, let's take a screenshot. Let's do market replay. Let's analyze that and see if that's something that we can perhaps in the future, upon seeing more sample size of that and gaining a better understanding of that, can become a part of our process, but not right away. Not right away. You sign up for the Slack room on smbfutures.com. I believe it's like join our community, or it's one of the first tabs that you can select up at the top. Sorry, I know I'm missing questions, guys. Do you yourself use footprint charts or only volume market profiles? And Delta you covered in this video. No, I use a footprint chart as well, and profiles and Delta. I use a ton of different tools. The footprint is lower on the totem pole, let's call it, but it does give me a read in terms of how much volume is being done, which is important. You know, there are times where I have a stop, let's say above some swing high. Okay. Well, I won't necessarily stop out if we trade one tick above the swing high, if we trade 3 ticks above the swing high, if I watch that footprint chart. And you don't have to use a footprint chart to see this, but it's just what I use. The volume's just super light, right? And how do you know volume's light? You've got to study your market. You've got to watch it. You've got to get that screen time. So if the volume's really light and it just looks like a little stop run and the volume comes back in heavy when the sellers start to drive it back down, I'm not coming out of that trade. If it goes back up there again and starts to build volume, what's the word? I'm blanking on the word I use every day. Trade is being facilitated. I'll come out of that quote real quick. Yeah, Dalton's books are relevant. I mean, Dalton's books, I think, teach about auction markets and about the profile itself. I think I don't have anything against anything in the books, but I find a lot of it not as objective and practical as I like. That's the direction I've tried to go or have gone with my market profile stuff. I've heard you mention pace. How do you measure that? Is it more of a developed feel for the particular market based on experience? Absolutely. You know, the pace of crude oil and what's above average, below average, or average, that's going to be something entirely different than you trading the bonds. That's entirely different. So it's absolutely market specific, and you've got to gain a feel for it. Now, I'm not an expert on this, but I have started to take a look at some of the jigsaw tools, which I know now include that gauge, which is showing kind of that pace of play, that speed of the tape. So I think that's a genius idea of a tool. Why not natural gas, for example? So why did I choose crude over natural gas? I just think it has better year-round volatility. I will trade some nat gas in the wintertime when the volatility seasonally picks up in that space. So it depends in regard to applications for our desk. If you are a CPT and you've got the runs over the past couple of years and it's quality risk adjusted performance, then yes, that'll be an application process. But other people who don't have that yet, but think they've got what it takes, it's a tryout process. I mean, my average clip size, let's just say it's substantial. It's pretty big. we'll just say I will push three digits in crude for time to time. Order flow is not in the market profile course. That is a context specific course. The new one that we will be coming out with that you can get grandfathered into, it's going to include, we thought after we did the first version of the course, you know what? Let's bring in some other price action and a little bit of order flow stuff to just give people something to really kind of start to get some traction with. But our plan is to develop further courses which specialize in each of those arenas rather than trying to make some course, everything for everybody. I do not spread. That's something that I might get into one day, but I've never put on a spread trade. It's only directional for me. No, my market profile course could not be further, Michael, from the 10-day course. The 10-day course is a very generic thing that S&P Equities has, which says, here's what it takes to be a professional trader. Here's how hard it is. Here's the mindsets and the work that you're going to have to do and things like that. Market profile course is very specific. Here's how to speak the language of the markets. Here's how to understand what's unfolding. Here's how to see a true risk reward contextually. That it's very practical. Yes, I think there's been a lot of questions around, is the video available afterwards? And Peter said he was recording and would also post it sometime later. What futures markets do I trade daily? Mostly crude and some S&P. From time to time, something else, whether that's soybeans, whether that's the Bund, whether that's nat gas. Just trying to think of something I've done recently. I keep up with, let's just say I keep up with a dozen or so of the most highly liquid futures products. And if I just see something just absolutely fantastic, I'll do that. Do your traders record their trading sessions? Some do. Different people use different software. Some use Camtasia, some use, in fact, one of the things I recommend to people is to create start a Google Hangout. This is nice. Start a Google Hangout and don't invite anybody, right? This is your private stuff. And just have it running. Stop it at the end, and it's going to be on. You don't have to worry about processing the video and doing all the hard work that goes into managing these large data files. It'll be on a YouTube channel for you. You can make it a private YouTube video where no one else can see it. I find that to be a good way to do it. I do a stream. So I'm using like actual low latency streaming software, which ultimately gets broadcast to YouTube. So mine's recorded. Those morning sessions that I do most days in the room are done that way. Well, guys, I've got to step away. This has been fun. I really hope that it's added value. I hope that it's been helpful. And best of luck. You've got my email address right there if anybody needs to reach out if we didn't get to, or I skipped your question. I apologize in advance.
Merritt, before you go, just like to say thank you. And that was a great presentation. I don't think we'd fight about much, to be honest. You said there. There was a question. It missed from Derek Clements, who must be from the gay contingency of the Jigsaw community. He was complimenting your moustache, and how could you be anything but super hot? And guys, I've got Derek's email address if you need it later.
a stash will improve your risk-adjusted returns by 20-fold. 20-fold, guys. If you don't take away anything I've said today, it's all about the stash.
And Derek, I think Derek agrees with everything you're saying.
Good old DC.
Thanks a lot. I really appreciate it. It was really good.
Thanks
to
for
hear
having
all
me, brother.
that. And we'll do something again, I'm sure. And thanks for everybody that turned up. It's really nice of you all to come. A lot of people just signed up for the recording, but it's nice to see so many in the room. And thank you, and we'll see you in the next webinar.